Good afternoon. Thank you for tuning into this week's edition of Your Business with Accent Nominees. In recent weeks, we've been looking at viable options through which we can finance, our businesses, our startups. Today, we'll be taking a step further also by looking at credit facilities. Basically, we're exploring credit facilities. Pardon me, I didn't mention my name. I am Daniel Ulukayode Adeyemo. So now, credit, what credit? Let's even bring it home. In our daily engagement, let's say Mrs. A probably decided to take a stroll out, and then on her way back, she realized that, she was supposed to get something. She was supposed to get sugar, and probably she didn't have any money, on her. So she just turns to the right and sees this woman that sells stuff, where she buys stuff, and then she's like, "Oh, ma, please, can you get me Dangote sugar? So I will send my kid to actually, get the money back to you." And then the woman gives her the Dangote sugar, and then she takes it home. What happened is that she got the sugar there on credit. So it's now for the kid to now, of course, come back and pay up for the Dangote sugar. That's now let's bring it down to let's bring it home a bit to what we're discussing today: relationship in terms of financial institutions and borrowers generally. So now for financial institutions, most of the times we see people approach the banks, for example, for certain amount of money, for their businesses and for other personal reasons as well. So in situations like this, there's an agreement as to the date you have to, of course, pay back the loan. And then there's also, apart from of course, the dates, you have to, apart from the date, sorry, apart okay, apart from the date, it's expected that you okay, all right. So apart from there's a date for payment, then there could also be an agreement on the interest to be paid. So it can be fixed, it can be it can be something that fluctuates, but that's based on the agreement you have. But then when we're looking at credit facilities, aka loans, there are three terms you must bear in mind. The first is the loan sum, which is a principal sum. The second is the interest rate, which of course we agreed upon looking at the agreement. Then the third one is the date for repayment, the date which you fix that, on this date we're going to come, and we're going to make payments, we're going to pay back everything, the principal sum, the interest rates, everything altogether you're going to pay. So now moving on, we're looking at types of credit facilities. Of course, we're talking about loans here. So the first one, we have secured loans, and then we also have unsecured loans. So by secured loans, we're saying that, when you borrow your money, you pledge certain assets, as a form of security, as a form of collateral, of course, just to secure the loan, just like its name connotes. Because in a situation where you are unable to actually make do with the payment at the agreed time, you lose that collateral, and there are other things you lose, which we'll be looking at subsequently. Now, secured loans also come with certain subcategories. We have term loans, which is what we earlier discussed. This is when, of course, a loan sum is advanced to you, for your business, of course, and you get the money, and then, of course, it comes with fixed. So the whole idea surrounding term loan is that they are fixed, decisions, that there's a fixed amount you're getting, there's a fixed amount of interest, and there's a fixed date for repayment. So that's one subcategory. Now the second one, we have mortgage loan, and that one here is, you get money to buy a property, for example. Actually, it's not even for example, that's what it's about. You get money to purchase a property, and then that property now serves as a security for the loan. So in a situation where you're unable to pay up within time, you lose that property. Yeah. So moving on, we have unsecured loans. Like its name connotes, there's really no need for any form of collateral whatsoever. But then the thing that comes with this is that the interest is usually higher. So you have higher interest, and it has its own subcategories as well. We have personal or consumer loan. Now this one is given based on two things. One is your credit history, and two is your ability to pay up, within a reasonable time, within the agreed time. Then, of course, in looking at this, they are looking at the income you get, from time to time, every month, maybe wages or income or salary or whatsoever. So now the first one is credit history. Now remember the scenario we gave where Miss or Mrs. B, takes a stroll and then she's coming back and then she realizes she needs to get sugar. Let's say she has been doing that before, and then most time when she tells the woman that, see, I'll send my kid to come and give you the money, and then most times she delays. It takes a week, 2 weeks, 3 weeks. That woman might not, want to actually, she would not actually want, because it's bad for her business. She won't want to give her that Dangote sugar whatsoever. So now this is where this, it affects this, because your credit history matters when it comes to personal or consumer loan. Your credit history, your credibility, in terms of being able to make do with loans you get in the past and bringing it down to the present. Now we have credit card loan. This one simply entails that of course you have a credit card at hand. You're allowed to withdraw beyond the amount you have on that card, but it has to be subject to the agreed limit. What I'm saying, let's say for example you have a credit card and then you have like 50,000 naira on that card, and then this one allows you to go ahead to withdraw beyond 50,000, but then it has to be agreed upon. So the agreement could be that, okay, you can withdraw 150 despite having 50. So the fact that you have 50 doesn't mean that you can now go ahead and withdraw 200 or 250. That is above the limit, which is 150, for example, like we've given. Now let's look at sources of credit facility. Now there are two basic sources generally. We have banks and other financial institutions. And take note, these banks and other financial institutions must have been licensed by the Central Bank of Nigeria. So as long as they are licensed, of course, you can have transactions, such as this. We also have cooperative societies. This one basically involves, members of the cooperative society. Of course, loan is advanced to a member, subject to terms and conditions. So you can either go for the banks and other financial institutions, or you can come down to cooperative societies, whichever one works. They are all protected. Now let's look at factors to consider before and when taking a loan. Now before taking a loan, you need to be sure of something. You need to be sure that you've exhausted, in law we call it all local remedies. You have to look at your surroundings. Who are those people that can likely help you with certain funds, before actually going for bank loan? Because most of the time, it's advisable that we approach our families, our friends, our colleagues, because most of the times when we even get this loan, before they get the return on investment, most of the time they're usually patient with you. They understand your business is just growing, and then you're struggling. You're working, you're doing everything you possibly can. So most of the time, once they advance this loan to you, they just chill and let you just do your thing. And when you start getting profit, multiple profit, return on investment, they can now come and pay or something. Or some might even say, no, you can take it. But when you just ignore this local remedy and then you just jump at the bank, most of the time the bank, they don't know you for madam. Of course, you have this customer or whatever relationship, but then once the payment date for you to repay that loan is due, it doesn't matter whether or not your business is still trying to pull itself together whatsoever. They come and then they get all they get every possible thing they can get from you, the loan sum, the interest, and then on that payment date. And of course, when you are unable to actually make do with these payments, you lose some other things which we'll be looking at subsequently. And now, when taking a loan, you have to pay attention to certain factors. Of course, the purpose of the loan. Of course, it's very important for you to know the purpose of the loan amount required, a specific amount of loan required. You need to know that. The ability to pay the principal and interest over the repayment period. Financial institution to approach. Of course, there are multiple financial institutions. You need to know the one you want to approach. Now, collateral for the loan. Now, speaking of collateral, I think we mentioned it earlier at the stage of the secured loans. Now, collateral can be conventional, of course, or movable. Now, conventional, I'm sure we understand the word conventional. That is what is common. Even without those of us that have never, borrowed for any reason before, we know one thing is that when you borrow money, you secure it with something, usually landed property, So that's like one of those conventional collateral. We also have plant and machinery. We have stocks, investment. Most of the time, these things are not things you can hold on to physical. They're usually something you perceive, you have somewhere. But then when we look and they're largely immovable also. So they're largely immovable, like land. Land is largely immovable. So now looking at the second one, which is movable collateral. Of course, just the way it connotes, it's movable. You can you can move it from one place to the other. So we're looking at livestock, we're looking at farm produce. This one was recently introduced into the Nigerian law, of course, in 2014, where you're allowed to use farm produce, livestock, inventory, as a means of security, as a collateral for loan, for any loan you take. So moving on, let's look at eligibility. That is, what qualifies you to be able to, have access to, this credit facility, this loan. Now, one thing is that of course, we're looking at it in respect of your business. You are getting the loan not for a personal reason, but for your business. So now, you need to provide a business registration document. So it's necessary for that business, which you are actually seeking that money, that loan. You need to provide a business registration document. Then you need to provide also a company resolution approving that, of course, the loan facility should be gotten. So there has to be a resolution. You're not the only one running the company, most likely, or the startup. There are other people with you. There are directors, there are members. It depends on. So it's not for a sole proprietorship. Of course, you might just make decision on your own. But where you are working with other people, where it's a partnership, there has to be a resolution that, okay, let's go ahead and borrow this money. So you need to present that resolution as well. So you need to have a solid repayment plan. How you're to pay up. So it has to be, you need to present these things also. Now, repayment of loan. When can we say that a loan has been repaid? The moment you pay off the loan sum, which is a principal, the moment you pay off the interest, and of course all charges attached to the loan, you are said to have discharged your responsibility with regards to, of course, paying the loan. And where it's a secure loan, for instance, like we mentioned earlier, the moment you pay up, the moment you make do with this payment, of course, the collateral is released to you. For example, like the mortgage loan we mentioned, which is a subcategory of secure loan. The moment you're able to pay, that landed property is released to you. It's for you. No one can take it from you. So that's one thing. Now, but when you're unable to meet up with this the payments, you can actually ask for restructuring. You can ask for restructuring of the loan. Now, let's look at default and consequences. So when you default in paying up, what are the things that come? We mentioned one earlier, which is the loss of collateral, that landed property. And most of the time, this collateral we're talking about, they are usually worth more than the loan, which you sought for. Of course, you believe that you're going to pay. That's why you didn't really use. Most times we have this collateral. We believe that it's easier to just go and get this loan rather than selling the property, because the property is so important. So when you get this loan, you now use that important property as a security. If you're unable to pay up, you lose that property, and that's why we call it a security, because it's something important to the person borrowing. The person will want to do everything possible to actually make payments so that it doesn't lose the collateral. And when you are unable to make the payment, you lose the collateral, mostly lands, like the conventional, and then there are other ones as well, like we mentioned earlier. So you also have poor credit rating. So what this one is saying, remember the story, the scenario we gave the other time about the woman that's probably, when she comes, please, I'll send my child to come and give you, and then at the end of the day, 2 weeks, 3 weeks, she has not paid up, just maybe Dangote sugar of like 150 or so. That woman won't want to give her anything on credit again. The moment you default, it affects your credit rating. That is, in the future, when you seek to want to maybe get loan for something, when they go through these things, most of the time these financial institutions and other bodies are unwilling to give you the loan which you desire. So let's say in the past you've been doing well, once there's a payment date, you make up. Even before the date, you already paid up everything. Of course, when you look at your credit rating is on point, they won't have issues with advancing loan to you in the future. So failure to pay up within the specific time affects your credit rating. Now, you might as well lose your business. Remember the scenario we gave about why you should consult family members. Let's say you didn't even consult family members, and then you go ahead to borrow the money, and then these people are coming for you for the loan sum, for the interest, and then even the business is still struggling. At that point, you're like, what are you going to do? It's very possible that you lose your business in that place, because you're still trying to find your ground. You're not established yet. You might lose your business in such a situation. And another one is prosecution under the law. Of course, that's a possibility. Now, let's look at important things to note when obtaining a credit facility. important thing to note when obtaining a credit facility. Now, the transaction has to be documented. That transaction has to be documented. It's advised in law. Anything you do, you document, so that we don't have issues of hearsay and all that. You document everything. Now, you execute a valid credit facility agreement. So an agreement has to be in place, showing what you're agreeing upon. Of course, the agreement usually contain the loan amount, the interest, the time you're agreeing to pay up. You're also looking at details of collateral, where there's any. The collateral, the details. Is a landed property, state where is it located, this and that. You give all the details. It's very necessary. Now, you can also consult professionals for guide. So this is where you can consult lawyers, to come to your aid and rescue, in terms of the agreement, terms and conditions, which I did not mention earlier. I'm very sorry about that. When taking a loan, one of the things you need to look at is also the terms and conditions. Sorry, and I'll be concluding with that. So it's very necessary for you when trying to get a loan, to pay attention to the terms and conditions. It is very necessary, because at that point, most times people are desperate to want to just get the money and just go on and advance it towards what you want to advance it to in the business. So it's advised, that you examine your terms and conditions, you look into it, you read it closely to look for clauses. So because most of the times there are clauses that will not favor you, so you look at it to see, what is this? Can you explain this? What is this? Because at the end of the day, once you sign, you are bound by it. You are bound by it. So it's very necessary for you to look at, examine your terms and conditions, your T&Cs, of course. So when you do this, you are safe. It protects you from future regret whatsoever. So the whole idea behind this is that don't act desperate when trying to get loans. You understand things can be tough at that time, but try to keep yourself together. Of course, try to keep yourself together when trying to get it, because once you sign that document without going through it in depth, you might extend to, I don't know, things may happen. I haven't experienced it before, but then people that have experienced it before will tell you the story behind it, which is usually not very palatable. So I'll be concluding on this note. Thank you for listening to us. Thank you for tuning in again this afternoon. I hope you're able to gain one or two things. If you have any questions, please feel free to leave it in the comment section down below, or reach out to us. You can find our contacts down below too as well. So thank you for your time, and please enjoy the rest of your day. I'm Daniel Olukayode Adeyemo. Thank you.